Okay, 19.2 is on calculating depreciation expense. We talked about depreciation expense at the very end of accounting one. And so we're going to pick it up again. It has to do with plant assets, hence why it is in our chapter 19. So the first thing we're going to talk about is straight line depreciation. And we know now that plant assets, because of their cost, how expensive they are, businesses expect that they are going to be able to be used by the business for many years. And because of that, GAAP requires us to expense the cost of a plant asset over their entire useful life. And that is because we have that accounting concept that matches expenses with revenue. So if revenue is made by an asset, we also have to match the expenses with that asset in the same time period where it earns revenue. So anytime that we have depreciation expense, it's going to be recorded as a debit to depreciation expense and a credit to accumulated depreciation. Now, in this lesson, we're not actually going to be journalizing. We're just going to be learning how to calculate depreciation. So the journalizing will actually happen later in this chapter. Now, there are lots of different methods for calculating depreciation, and we'll talk about some of those later in this chapter too. But for now, what we're going to worry about is just straight line depreciation. So it is the easiest and most widely used method. And the three things that we need to know in order to calculate straight line depreciation is the cost of a plant asset, the estimated salvage value, which is essentially how much is the business expected to receive when we go to dispose of that plant asset. Now, whether you sell it, if it's a car and you sell it for so much money, that is its estimated salvage value. It also could be $0 if the company just plans to discard it or throw it away or recycle it or whatever it happens to be. You can have a salvage value of 0. And then the last thing that we need to know is the estimated useful life, which is the number of years that a plant asset is expected to contribute to the earnings of a business. Now, just note that it says estimated salvage value and estimated useful life. We can't say for certain that we're going to be able to sell something at the end of its useful life for a certain amount. We can't say that. That's why it's estimated. Same thing where we can't say that a plant asset is going to last us 10 years. We don't know that for certain. So it is just an estimate of those two things. Now, the straight line method of depreciation charges an equal amount of depreciation expense in each full year in which the asset is used. So hence, that's why it's called straight line. The amount of depreciation doesn't change year to year. So the way that we calculate that is by doing the following. So let's say, for example, a company bought a shelving unit for $8,500 with an estimated salvage value of $500 and an estimated useful life of 4 years. So the first thing we need to do is we take our original cost, which was $8,500, and then subtract out the salvage value because we hope to be able to gain that much back. So $8,500 minus $500 gives us an estimated total depreciation expense of $8,000. That's how much we need to dispense over our shelving unit's useful life. So again, then we take our estimated depreciation expense, which is $8,000, divide it by the number of useful years we're going to have with it, which is 4, and we end up with annual depreciation expense of $2,000. So every year we're going to expense $2,000 for our shelving unit because that's how much total depreciation expense we think that it is going to have. Now, there are, of course, nothing is ever perfect, and so there are going to be times where we buy a plant asset and put it into use, not at the beginning of a fiscal period. So the smallest amount of time that we will calculate depreciation expense with is a month. We're not going to break it down into days because that would just be too tedious. So instead, we can break it down into parts of a month or into a month. So when we do this, what that looks like is, let's say that a company bought a computer on September 3rd of the current year and the annual straight line depreciation expense is $900. So what we're actually going to do is we're going to take our annual depreciation and expense, which is 900, and divide it by the number of months in a year, which is 12, which means that every month we are expensing $75 worth of that computer. So because we have, if you count September, it's September, October, November, December, that's 4 months. We take our monthly depreciation expense and multiply it by 4, and we get a total of $300, which we would expense for that year since we put it into service on September 3rd. On the next slide, what I'm going to show you is that how it's going to look, because if you remember, we bought that computer with the expectation that we were going to use it for 3 years. And so I'm just going to show you what that looks like when we put something into play when it's in the beginning of the year. So remember that the first year, the one we just did and calculated, we only used it for 4 years. And I just want to touch on the fact that we started and included all of September because September 3rd is closer to September 1 than it is to October 1. If we would have bought that computer on September 16th or later, we would have started in October because the date is closer to October 1st. Remember, we don't break it down into like depreciation expense for days because it's just too tedious. So the next 2 years obviously would be a full year's depreciation of 900. And then in the final year, we only used it up to August 31st because that would be a total of 3 years. So 8 months depreciation would be recorded. So that actually looks like this. So here's this $300 that we calculated first, the 75 times 4. Year 1 and year 2 are the full 900, and then the last 8 months is 600. And you could see here's 8 months and 4 months. That's a total year. So the total useful life of 3 years is expensed like this. So this is what happens where if we don't put a plant asset into play on the very first day of our fiscal period, because that's not really very practical. We would buy, we could buy land, we could buy new equipment, computers die, we have to get new ones at any point in time. So this is what we would have to do if we were going to expense for part of a year. Okay, the other thing that we have to pay attention to when we're doing depreciation is that we will have something called accumulated depreciation. And what that simply means is that depreciation is not recorded as a reduction in the plant asset account. So just like we've talked about before, we have contra accounts, and each plant asset has a contra account for accumulated depreciation. So that's where we keep track of the depreciation expense for each year of the plant asset. And so, I have it backwards here. The accumulated depreciation for a plant asset in the current year gets calculated by adding the depreciation expense for the current year to the prior year's accumulated depreciation. So essentially, we had up to, and we're talking about that computer still here, we had $1,200 of accumulated depreciation plus our current year of 900, which means that our total accumulated depreciation at the end of the current year is $2,100. So you just keep adding to it throughout the course of your useful life. So, and this maybe kind of better describes that here. So each plant asset is going to have an accumulated depreciation record similar to the one below. It talks about what depreciation method is used. It shows the original cost, the salvage value, the useful life, and the date that it was purchased. And so then here we have the annual depreciation in the first year, remember, was just September to December. So total for that year was 300. That didn't go anywhere. Then the next year we had $900, a full year of depreciation, which then we add to the previous year's accumulated depreciation, so we end up with 1,200. And so you can see how you just add the current year's annual depreciation expense to accumulated to update your accumulated depreciation balance. And then the last thing that we need to talk about is book value. So book value of a plant asset is simply the original cost of a plant asset minus its accumulated depreciation. And we want to make sure that we know that because knowing the book value of our assets is very important. And I would think that this would be self-explanatory, but in case it's not, just remember that the ending book value at the end of a fiscal year turns into the beginning book value of the next year. And you can kind of see that on that previous um, slide where we had the accumulated depreciation report. But one thing that we need to remember too is that plan assets, even if remember that we estimated useful life. So there's always a chance that you might use your plan asset longer than your useful life, and that is totally fine. It's just that there's going to be no additional depreciation that gets recorded after that point. So ways to calculate your book value. The one that I like to use the most is taking the original cost of our computer and subtracting out the accumulated depreciation to get your book value. You can also do it by subtracting the year's depreciation from this should be, I don't know why I have bears. Don't chase the bears, everyone. No, there's my typing skills in um, perfect form there. So ignore that. That should just be from the beginning book value. Either method that you use is going to be acceptable because they both calculate the same value. So whichever method you choose to use is fine. This is the one that I find most simple to use, is just taking your original cost minus your accumulated depreciation. If I backtrack here to show you this slide, you can see this at work. Here's your beginning book value. Um, Subtracting out your accumulated depreciation, you get your ending book value, and see how that becomes the beginning book value for the next year. So that's the one that I like to use the most, but whichever one makes most sense to you is just fine. So that brings us to the end of 19.2, which was on calculating our straight line depreciation either for full years or for partial years, and then also calculating our book value. So you can meet me over on the 19.2 work together video, and we will do that next.